Hello guys, on this video I'll be teaching you how to derive market bias from economic data. So if you're finding it so difficult getting your bias from economic data, stay tuned to this video is over. Alright. So first of all, when you are looking at your economic data, when you open your economic data, what you have to pay attention is what you have to pay attention to the previous, you have to pay attention to the forecast, and you have to pay attention to the what actual. These are the three things you have to mainly focus on when you're looking at your economic data. When you're looking at any data that is coming up, whether CPI, NFP, retail sales, unemployment claims, whichever data that is coming up, these are the three things you pay attention to. So now let's break them down. What is previous? Previous is the last data report that was released it's the last data report that was released. And what is focus? Focus is what? Focus is what the market is expecting. This is it. What the market is expecting. What the economics analysts they are expecting from the market. That is what focus is talking about. And what is actual? Actual is the real result that was published. That's what actual is. The real result of the data that was published. Now, we have known what is previous, we have known what is focus, we have known what is actual. How can we get bias from this previous, focus, and actual? Now, let's use CPI for an example. CPI, there's an inflation in the country because CPI is talking about inflations. Let's say there is previous inflation of CPI was what? 3.1%. There's the previous data of CPI. And now we're having forecast what the market are expecting. They're expecting that what? Inflation is going to be high. It's going to high by 3.4%. This is what the market is expecting. This is what the analysts, economists, they are expecting from the market. That the inflation of, for example, let's use USD. For example, let's use USD. That the inflation of USD is going to be high, which is giving us a strong currency. And now, actual haven't been released yet to confirm whether the expectation is actually right or wrong. Now we waited and actual came out, giving us that inflation came out to be 3.8%. Now, it didn't come out what they were expecting. It came out higher than what they were expecting. It didn't came out below previous. It came out higher than previous, which giving us that what? Currency is strong. Which giving us that what? USD is strong. Because when there is a high inflation in the currency, in the country, the currency becomes very strong. USD is strong. Now, our bias is that what? Bias is that USD is bullish. USD is bullish. This is how you get your bias. Your bias is that what? USD is bullish. Because why? Data came out higher than forecast. Because once data come out, what you have to do is to compare the forecast to the actual. Now we'll compare the forecast to the actual. The forecast was 3.4%, and actual came out 3.8%. This is telling us that there's a slight increase. There's an increase in inflation, which strengthens the currency. For example, let's look at this in my forest factory. This is my forest factory. This is the news that will be coming out. This is the news that will be coming out tomorrow. NFP coming out. And now we're having out USD unemployment claims. Look at this. Previously, look at the data. Previously, it was 211K. And now the market is forecasting that there will be slight increase in an unemployment claims. And look at data. Data didn't come above the forecast. It didn't come above the previous, but it came below the both, which giving us that there is a low unemployment claims in USD, which support the USD and give USD a bullish bias. Now we're having USD bullish because lower unemployment claims strengthens the currency and higher unemployment claims weakens the currency. So whenever you see unemployment claims comes lower than the forecast, comes lower than the previous, it's telling us that what? Price is strong. But whenever it comes above the forecast, it's telling us that price is weak. Unlike NFP, if NFP comes above the forecast, it's telling us that USD is strong. But if it comes below the forecast, it's telling us that USD is weak. You see it? Now, I believe this video have taught you how to get your bias from economic calendar by just using your previous forecast and actual to get your data. And I've explained how you can be able to connect your bias to the chart on the last video I did. So this is it, guys. If you are new, don't forget to subscribe to the channel to join the family, and don't forget to like and share to your friends as well, and link in my bio to join my community. All right, take care and bye for now.